enjoyed this earnings setup. The best I can say for it is meh in terms of where the sentiment is. Usually it really leans quite bullish, and then you see that cycled again post-earnings. You're not seeing that this time, but you're also not seeing extremely bearish sentiment. And again, that plus or minus 10% implied move, Katie, is actually pretty in line with the realized moves we get in the last 8 quarters.
And if you take a look at what the pricing is for the broader S&P 500, I brought this up at the top of the show, but I believe for the day after on Thursday, the S&P 500 is priced for about a 1% move either way, which is what you usually see for Fed meetings. So this one report from this one company, investors are looking at this with the same importance as a Fed meeting. Is it that serious?
You know, I think if you look to history, yes. Yeah, we kind of saw this change in about May of 2023, the first time we got that blowout earnings when AI really became its own narrative. And since then, that skew in the options market has been so important in generating further momentum. And we think about just the market in terms of factors. What is outperforming? It's momentum. So if momentum begets momentum, and NVIDIA is driving that momentum, then yes, I think that could certainly change the direction. That's not what is being priced in right now, but that certainly could have the impact.
I want to talk a little more about what's under the surface here, even beyond NVIDIA. You have over the weekend Citigroup Stuart Kaiser saying that the stubbornly high VVIX, despite 2 weeks lacking clear macro catalysts, suggests that positioning risk is lingering in markets. Risk takers also seem cautious about adding too much exposure with that September 6 payrolls looming as a large digital risk event. When you look at the derivatives market, where does positioning stand, and how drastic could moves be from here?
Yeah, you know, one thing I like to do is just think about the analogy of you're on the airplane, you stabilized, but you didn't forget the turbulence, your seatbelt's still on, right? And I think that's sort of what Stu is saying there, which is, no, VIX is not at that headline 65. It's not in that sharp rise anymore. We've kind of stabilized on headline numbers, but all those secondary factors that we watch so closely in derivatives are really continuing to show nervousness. And the reason is institutional memory is quite short. So when realized volatility is quite low, that's all you remember. But when you've had recent spikes, it's hard for investors to forget that. And so maybe they're not betting on large moves, but they're certainly starting to protect for it. And that is a major difference, because for the first 6 months of this year, no one wanted to hear the word hedge. They didn't want to hear the Cassandra story, and that has changed.
What's interesting about this idea of hedging is how much more expensive is it getting to hedge at this point? Are we going to face a point in this year where that risk becomes so prominent that it becomes too expensive to put on some of those hedges at this point?
You know, it's interesting you say that. I think this is one of those really counterintuitive things about the options market, which is when hedging tends to be low, no one wants to do it. And also the reality is it doesn't pay off. It actually takes that pickup in expensiveness to get people thinking. And of course, why are we in this situation? We have situations in the Middle East. We have an upcoming election. We have the potential dragging of an NVIDIA story, right? There are all these things, all these cross currents that are coming to bear. And it's shown that the market from a positioning perspective can react quite negatively to that. So look, yes, hedges can be expensive, but we have still continued to see them pay out in those situations.
You know, I was chatting with an investor over the weekend who made the point that when it comes to hedging, okay, when the market goes up, then I regret it because I could have had more money in the market. And then when I actually do need that hedge, it's kind of like, you know, it went down a little bit for like a day or two, but now I'm right back up again. For those investors who had been hedging, when we were talking about when volatility hedges were still so cheap, did those actually pay off? I mean, you think about that sort of human psychology feedback loop of, you know, not hedging and then, you know, not needing to hedge. Where are we there?
So I'd say the answer to this is nuanced in the sense that this means you have to be more careful and thoughtful about your hedges. So maybe you don't sit on outright put options. Maybe you're owning a put spread. Maybe you're owning a put spread collar, right? So you're thinking about ways to carry your hedge better. But I will say this has caused quite a great deal of existential dread in our universe, because it is true. When you look back to the drawdowns of 2022, right? Market drew down 20%. hedges didn't pay off, even though we had a drawdown because of the path. So you have to be really good on timing. But look, when you do have these spikes, they do tend to work. It just has to be very thoughtful how you structure them, which is why our roles exist.
Amy, stick with us. We're going to talk much more about what you're seeing in the market alongside clients. But for now, coming up, we're going to talk about why Telsey Advisory is souring on Lululemon. Big week for the consumer story. We're going to tell you exactly what's going on next in Top Calls. This is Bloomberg.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it will be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Open Interest. We're going to get a quick check here on the market. We have stocks on a tear higher, marginally really, less than 0.2% higher on the S&P 500, but tech stocks not feeling the same kind of love. The NASDAQ 100 down 0.2%. Small caps getting more of a bid with expectations of rate cuts around the corner. You have the Russell 2000 index up about 0.5%, Katie.
All right, it's time now for our top calls. Some of these analyst action in focus this morning. And first up, Argus Research says that Wayfair no longer a buy. The firm cutting its rating on the online home furnishing retailer to hold, saying that the company's prospects appear muted in today's high interest rate environment. Next up, Daiwa Securities giving Target a buy rating and boosting its target on the big box retailer. Target, of course, reported earnings and sales last week that topped estimates. And finally, Telsey Advisory Group cutting its price target on Lululemon to $360 from $470. Analyst Dana Telsey also moderating her sales margin and earnings estimates for the back half of the year, Shonali.
And we're back here now with Amy Lou Silverman, RBC Head of Derivative Strategy. And, Amy, one thing we were talking about during the break here is this idea here that you have the S&P 500 that is still so close to its all-time high, but you also have gold $5 away from its record high and Brent now up toward an 81 handle. How can all of those things be true?
Yeah, it's a great question. And I think the reality is over time we've shown that it can't necessarily be true. And one thing we were talking about is this idea that, while traditional hedging, perhaps, S&P put options or what have you, haven't been working as well, we've seen these alternative hedges in gold calls, for instance, or in energy. And these have been more direct ways for investors to express their concerns, specifically if they have a geopolitical concern or specifically if they have an inflation concern. And that in the last 6 months to a year has been popular for folks who are looking for hedges, but not necessarily on a market level, given the influence of heavyweights in the market itself.
When you think about that need to hedge in gold and energy, is it more of a hedge these days, or is it a bet on price? Are people getting out of the S&P or keeping cash on the sidelines to reinvest later, or are they putting money in gold to wait out the storm that we are slightly experiencing now?
Look, it's a little bit of both, but what I will tell you is there's so many cross currents for why certain people would want it as a hedge or others. I think it comes down to, if you as an investor, what is it specifically that you're nervous about? Are you nervous just about the inflation story, the rate story? Are you nervous more about the geopolitical risk? I think that ends up being expressed much more in sectors now because you have this issue of the correlation on an index level that you hadn't really to the degree that you do now.
And it's so interesting, thinking about these alternative hedges and that sort of existential crisis that you mentioned before the break when it comes to your industry, because people are changing how they hedge. And I'm curious what activity you're seeing in some of those volatility selling funds. You think about, funds such as the JP Morgan JEPI product, for example, which has just taken in so much money. How is that filtered into your space, the derivatives market? Because there's certainly a lot of consternation about what that could mean.
Yeah, this is a question that I think there's a lot of hand-wringing on. I think we as derivative strategists get this all the time. The one analogy people keep pointing to is this going to bring forth some sort of Volmageddon, a February 2018-like crisis? To me, the short answer is no. It's very different in terms of what the product suite is and also the leverage in the market. So those two things are different. Now, does that mean that it isn't influencing the supply-demand of the market? Of course not. Of course there's an impact there. I would say one thing we have not discussed, but is also important, is the rise of zero-day to expiry options. When you look at the SIBO stats on that, that's almost half of all S&P volume. That's also influencing how things are trading, how we are seeing the implied volatility and realized volatility of the market trade now.
Well, how so? Because, again, I'm a mere mortal, so I just look at the VIX. Sometimes I look at the VVIX if I'm feeling fancy. But you talk about zero DTE and that influencing the trade. Where are you seeing evidence of that?
The best analogy I've come up with is, because I do agree, I think if you don't look at this every day, I don't think you can appreciate kind of the change in the market structure. But it's the idea that options used to be your GPS system, right? You're driving in the car, you used to have 1,000 feet to make that left turn, but when all the activity has gone so short tenor, you really only have 10 feet to make that left turn. So what I've been saying is your early warning system, which is what the derivatives market has been, is getting shorter and shorter in tenor. And so when you get these spikes, Monday, 3 weeks ago at this point, I think people are less ready for that. And that in itself has caused some psychological nervousness.
Another question I have is really outside of the S&P 500, what we're seeing, because one popular trade that became quite unpopular through most of August was that Russell 2000 small cap trade. And now we had Jackson Hole. You now see a bid in that Russell 2000 today. It's just a day, but you still have it outpacing what you see this morning in the NASDAQ and the S&P 500. Why, frankly?
The best anecdote I can give to you, I was marketing in Toronto maybe a few weeks ago, kind of 30 clients in a room, and I said, raise of hands, this is while, Russell was doing quite well, how many people think that this kind of rally is sustainable and the rotation is here? And then I got like 3 sort of hand raises, and that just tells me a lot about how much buy-in there is, because ultimately when you get these flights to safeties, where do they go? They go back to the big boys, and you really see that in the underlying options positioning. You don't see that IWM call skew lifted right now, and I frankly personally don't think it continues. I think it really depends obviously on the rate story, but when you actually look at positioning and pricing, it's not there. That exuberance is nowhere close to what you see on the mega cap type trend.
That's really interesting. So, I mean, we don't have much time, but just to really distill that into a single point, that hot and cold options trade or that rotation trade, you aren't seeing the follow through in the options market.
Not at all.
Interesting. All right, Amy Wu Silverman, it's always great to catch up with you. Appreciate your time on this Monday. She, of course, is RBC's head of derivative strategy. Now, coming up, the trouble at Telegram. We've got the latest as the company questions France's detention of its CEO. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs.